Hello and welcome to the download. I'm your host, Dave Richardson, and it is Tuesdays with a very well-dressed Stu Kedwell because we're making a videotape today, Stu. So you got the message.
I did. I put the tie on, Dave, just so I could actually one up you, just
I know.
because you.
I know what you're up to.
Well, and I have my summer suit on. It's a tan suit, and you can only wear it until Labor Day. So you have to get these things in when you can.
So you still follow that kind of stuff. You're
I'm
you're
very superstitious when it comes to, and I think that's a superstition, although maybe it's some type of universal rule. I'm not sure, but I definitely put it back in the closet come the weekend.
all kinds of negatives on climate change, but isn't that one of the positives that you can wear your summer suits pretty much to Thanksgiving now because we get pretty good weather through the fall.
Yeah, I guess so. I just it's maybe it's my mom's doing. May 24 to Labor Day. I'm gonna abide by it.
And then you'll even get I think we've even had 30-degree days in March in Toronto. So you
Yeah,
could pull the
I could
you
pull it out. Yeah, I could go
haven't
with the
gone
white
more to
pants.
the weather dependency.
Not yet, not yet. I'm a stickler for those old-fashioned rules.
Well, I just Stu just gave a big tip for what's going to come on videos, future videos here. So for all of you who have just started watching us on YouTube, I know thousands of you listen to the podcast, but we've only had a couple hundred people on the video. So those of you watching the video, tell your friends, and those listening, get onto YouTube and start watching the video version because the next Tuesdays that we videotape, it's Stu in white pants. He just said he's going to do it, and he's been and as you can see, he's been working out.
Yeah, I think white pants are slimming, so maybe I'll give it a shot.
Got to make sure your glutes are firing on that
Yep.
episode, Stu. There we go. So, so Stu, we got we're gonna do an investment stew today. We're gonna bounce around, lots of stuff going on. You suggested maybe a specific soup or something you want to stew up in the pot.
A stula
Yeah.
base, a stula base.
A Stulia base. Oh, very nice. We're getting fancier. Actually, this will be pretty fancy stuff we're doing today.
Yeah, well, we are
Be,
video, so we have to take it up a notch.
I know we got well actually oh yes that's Emeril Lagasse. He would
Yeah,
make a good bouillabaisse or stoulia base.
yeah.
So we will kick it up a notch here, and let's start with Jackson Hole, which would be kicking it up a notch in terms of just our where we are because it's beautiful there. I haven't been, but people tell me it's beautiful there, and also that I can't afford to go. So I assume it's a pretty nice place. Have you been there, Stu?
I have not been there, but it did look pretty sweet on the video.
I was reading an article that it's actually it's where the really rich people go who are tired of going to Aspen.
Oh,
So it's developing that much. But the people that did go for that meeting to go up to Jackson Hole was the Federal Reserve, Jerome Powell and his gang of Federal Reserve presidents to, I guess they do this annually, Stu?
and they do it annually. Yep, and they get talking about where they think monetary policy is headed, and I thought this one was interesting, because we've had periods of concern about is the economy slowing, will the Fed lower interest rates, and they were fairly definitive that they now see rising unemployment as a real risk, and something, I think they use the words like something we don't welcome. And I think it's pretty important, from a market standpoint, not just whether or not the Fed intends to lower interest rates, but whether or not it's in front of or in advance of or behind. Um, if you get in a situation where the economy is slowing, maybe earnings are slowing a little bit, and the Fed has ammunition to counter that by lower interest rates, and you believe that they will, in fact, consider that risk, it changes investors' mindsets a little bit. And it allows them to then look a little bit farther out to, well, what will happen if the Fed is successful in lowering interest rates and re-stimulating the economy, and what would the economic and earnings picture look like in that environment. And markets received the Fed's message pretty resoundingly. They were pretty enthusiastic about it, which always requires a little bit of thinking. But I think what's been interesting in the last month is that we talk a lot about the S&P 500. We talk a lot about the average stock, and the average stock made a new high. The market hasn't quite made a new high, but the average stock has done pretty well. And the character of some of the things in the market has changed. The number of stocks that are participating in this has been better. Some of the sectors that are participating have been different. Importantly, financial stocks, which we've talked about a couple of times, have been pretty strong throughout. And that is the market's way of maybe saying that we're a bit more comfortable with a soft landing. If you could get shorter interest rates coming down, get some slope in the yield curve, so banks make more money on net interest margin, or eventually they will. And so I thought that was probably the most interesting part. Just this notion that inflation's come down. We talked last time. It reemerging would certainly be a risk, and we've thought a lot about that. But the idea that the Fed is a little bit more balanced in terms of what they're going to be looking at.
Yeah, and very interesting. So first of all, we had Andre Skiba on last week talking about interest rates in the U.S., and we were in the middle of Jackson Hole, so we didn't know exactly what Chairman Powell was going to say on Friday and what exactly would be said coming out of those meetings. We did a little speculating on it, and one of the key ideas is that when we get to September, and this is really what Powell essentially confirmed, we got to be careful. It's never done until it's done, but that the Fed will be start to cut rates in the middle of September. September 18th is the date they'll make that next announcement. And at that point, you can go back historically and you can look at the way markets perform over the next 12 months. And then you can look at the kind of conditions that you have in the market at the time that that first rate cut takes place. And so for stocks, that's critical, because if the cutting of rates is indicative of a really bad economy, then that's going to be bad for stocks over the next 12 months. But if the conditions for the economy are just a slowing economy where the rate rises were generally designed to slow inflation and calm the market down, the economy down a little bit, so that we could get back on the next cycle, get into the next cycle without any kind of real economic damage or dramatic economic damage, that stocks actually do pretty well over the next 12 months. In general, because those two scenarios play out well for bonds either way, that the bond market ends up being pretty good once you get that indicator. So that line in the sand where we move from rising to waiting to actually cutting, that line is an important line, and it looks like, if we interpret it the way I think you did and I did, and the way the market's interpreted, Powell kind of drew that line. It's like we're about to go lower, and so now market participants can start to do that recalibration to determine what should happen next, right?
Yeah, that's bang on. And I would say the thing I would add to that is, in the next 3 months following that line being drawn, the path of unemployment is very important.
Ah,
And if unemployment, kind of peaks within that 3 month period, and then, employment starts to grow again, unemployment starts to come back down, that pretty much like seals, the soft landing. So yeah, you have kind of two 12-month scenarios, but you've got some road signs
okay.
that we'll be paying careful attention to over those next 2 or 3 months.
Yeah, because so that 3 month period is where we're really going to start to see what kind of an economy we're about to have as a result of all the tightening or the higher rates
Yep.
that we're starting to move away from. Because you're right, and the markets are kind of showing that, I guess, with the volatility we've seen over the last 2-3 weeks, is that you're still not at this point exactly sure just how bad the economy might get through all of this.
Yeah, I would say the one cushioning factor is just that first point about uh, do investors' time horizons lengthen a little bit if the Fed is cutting interest rates? Like, we've kind of grouped the market into these kind of three baskets of stocks that we've discussed, and the middle basket is likely the most important at this juncture, which is quality companies with modest economic sensitivity. So if you're sitting there owning those companies and you have an idea about how their earnings could reaccelerate, before maybe you're debating will they or won't they. If the Fed is lowering interest rates, you're debating when will they. It changes your mindset a little bit, and makes like some of those quality companies that are paying very good dividends a bit more interesting at this juncture. Just because you're like, well, I'm getting paid to wait with the current dividend, and I have this sense that as the Fed lowers interest rates, it'll improve the economy and create the conditions for earnings growth and then future dividend growth.
And that when we start to talk about dividends and scenarios around interest rates and yield curve slopes and future earnings, and it almost always takes us back in Canada to the Canadian banks who are in the midst of reporting. Anything interesting going on in those numbers that you've seen thus far?
Yeah, so I would say we've had three banks report. Probably the most interesting thing is that in we're within, whether or not it's taking place or within a quarter, like the Canadian consumer and the concern over the Canadian consumer and the provisions of credit on the personal side of the business, like we're in the final innings, it appears, of that. And some banks have seen their provisions dip ever so slightly, maybe a little bit higher than last quarter, just on the personal side. Um, so I think as interest rates have come down, the sentiment around the Canadian consumer is not one of like overjoy, like
Yeah.
high fives and handshakes all around, but maybe through the worst of the pinch point. And investors do tend to be like rate of change people, right? So a negative that's getting less negative ends up being a positive. And I think we've seen that so far out of three banks. Uh, couple there's still some one-off files on the commercial side of the equation, actually more so in the United States than anything, that are still coming through. But we spend so much time talking about Canadian mortgages and higher interest rates. Well, yes, they're still going to be higher, but they're not going to be as high as they were if it had been the early part of the year. So there's a couple of modest positives, I would say, uh, for the Canadian consumer so far. And the banks, the rest has been pretty much as expected. Like loan growth has been pretty slow. Not a surprise. Capital markets been not bad, and wealth has been better, with just because markets have been so strong.
Markets have been so good. Yeah. Yeah. Well, one of the charts I put up when I'm out with real estate professionals is a chart that shows all the maturing mortgages that are coming over the next 2.5 years,
Yeah.
and the typical rate that they're maturing at. And so you look at today's rates and you go, wow, if somebody has a mortgage that matures a year and a half from now and the rate is still where it is today, then wow, that's going to be quite a bit of money out of their pocket. But as you start to project out now, and some of the projections, we have to say, and the market has not been perfect on this, and never is perfect on it, but some of the projections on where we get to with rates over the next 12 to 18 months actually gets those rates not down to where they were, because we may not see that again for a long, long time. Rates as low as they were in the middle of COVID. We were shutting down the global economy. We're hopefully not going to do that again in our lifetime. But but getting back down to where the pinch won't be too bad. And then of course, along with inflation, we've had some wage growth in the interim as well. So hopefully the damage that does the consumer is very much moderated or virtually eliminated by that movement in rates.
Yeah, and I think the other thing I'd add to that is there's been like a sequencing a little bit too. There's food costs more, again, not going down in price, unfortunately, but it's not going up at the same pace. So budgets have been able to recalibrate, and the one last thing in the budget that needs to be dealt with is slightly higher interest payments. when you renew your mortgage, but it's not like it's all happening at the same time. And a lot of wage improvement is still in the pipeline because when wage deals have been signed, it might be for a 5 or 6% increase over each of the next 3 years. So there's also some things that come through, on the positive side that assist with the overall budgeting process.
Yeah, and not everyone has two daughters heading to university this year like I do. So they're doing hopefully a lot better with their budgeting than me, or my 3-hour drives to Kingston with a rented van, which has become my sort of everyday activity.
Well, I'm in the same camp. Mine's off on the Saturday for first year, and I've learned, is it possible to have enough? It's not possible to have enough throw pillows. That's that's what I've learned. And so we're keeping the throw pillow business in good stead.
Well, when we get to something that may or may not be possible, let's just finish off today with we're here on Tuesday, August 27th. Wednesday, August 28th is a pretty significant day in the market because one stock, Nvidia, has started to garner, probably more attention than any other stock in the market, and might be viewed as sort of the quintessential AI stock, and that's one of the things that's been driving markets and is driving optimism about market, not just today but into the future as well. They report their earnings after hours on Wednesday, and the expectations, as always, have they sold enough throw pillows over the last quarter to meet those expectations, Stu? I know you're helping out, and lots of companies are helping out buying their throw pillows, which are, I guess, actually
Servers.
AI chips
Yep.
and servers and stuff. But can they do it? And why could this be such an important earnings announcement? We never like to focus on just one company,
Yeah.
and we very rarely do, but this is one that just kind of seems where it's happening, when it's happening, that this could be somewhat important.
Yeah. Like it's important in the short term. Like it's always funny when you go look at the long term track record of the market or of a money manager. There's lots of events that feel like the Super Bowl contained in that long term track record. So no one is ever as important to getting to your financial goals as you might think. But in this instance, it is the a lot of other of the kind of highly valued stocks have fallen a little bit by the wayside. It is the one that sits at a still in a level that has shown fairly strong price appreciation. So there would be a very significant expectations that the expectations will be beat, right? We would have to do a podcast on whisper numbers, but you could whisper something and it likely has to be better than that. That the guidance going forward needs to rise to keep the momentum going, and the reason for that is not so much Nvidia's price earnings multiple is definitely elevated, relative to many others. But what's very important there is the revenue growth and a very tight demand for their products, which allows them to earn the margins that generate those earnings, right? And that's the function is as an analyst, you're kind of looking at it on a number of different ways. Will it be better or worse than expectation? There's lots of surveys that have been done on the sales, and as I say, like when you're in a situation where people expect it to beat expectations, that their business is strong. Will it be strong enough for the market's current appetite? Time will tell. But in the context of being a long-term investing, looking to kind of compound your capital over many years, it's just kind of an event. It's not something that is the driving force in a long-term financial plan.
Sure. Or when you have a highly popular podcast like we have to continue to say that there's exciting stuff coming up that we're going to talk
That's right.
about so that people will listen again to Tuesdays next week. So there is a little bit of that in there. But you did mention something that I found really interesting just when we were talking before we started, that when you look at different market events and the way the market thinks, or the way different people, market participants think the market will react in terms of volatility and how much it'll affect the movement, this actually does line up as a fairly significant event when we talk about jobs reports and inflation reports, which have been so important over the last year.
Yeah, I read on the weekend, and I wish I could 100% explain it, but someone who is, kind of divided up what are likely to be the most volatile days in the next month, and the Nvidia earnings day kind of tops the charts above employment, above CPI, and that's interesting because there's so much wealth tied up in Nvidia right now at its current market cap. It it definitely it wouldn't be a situation, whether or not it barnstorms forward. I don't think that's important, but you wouldn't want to see a substantial correction in its valuation, because that would likely mean two things. It would, one, it would go down, but then it would also likely mean that the vision of the future was not quite as robust as people felt, right? Like you only know, like, when a tree is growing to the sky, you value it like you might go to the sky. Once it doesn't grow to the sky, you're unlikely to assume that it will, if you know what I mean, right?
Yep.
And that's the trouble with these kind of high expectation stocks, and that's what I mean. Like, in the context of a portfolio, they're never the kind of driving factor in long-term returns, inside of an index or what have you. But in the short term, you can get a lot of discussion around these events.
Yeah, well, I think the analogy we were using when we talked about this, so maybe 9, 12 months ago, is the idea of, you set expectations with, say, my wife, right? Like, when are you going to be home? Oh, I'm going to be home at 7:30, and then I arrive at 7. So I've beaten expectations. Good, right? And then the next time I arrive at 7:30, I arrive at 6:45. Better, right? And I
Yep.
consistently arrive at 6:45 and 6:30, and then all of a sudden the expectations are that I'm gonna consistently, I say 7:30, but she starts to think actually it's really 6:30 he's gonna be home. So I don't get home by 6:30. I've actually disappointed her, even though
Yes.
I said I was going to be home at 7:30. That's the way expectations can get out of whack. And then on top of that, when we talk about a company like this and other companies where they sometimes get through the earnings cycle, these high growth companies with big expectations, is, I say 7:30, I arrive at 6:30, and that's not good enough because she was hoping I'd arrive at 6:15, and then I have to tell her next time I'm going to arrive at 5:30. So I just keep ratcheting the expectations higher and higher and higher to the point where you just can't get there, which is your tree growing to the sky, just a different way of saying it.
Yeah, because you run that forward and you have to arrive home before you've even left for work. That's the law of large numbers.
See, I knew you'd get to you'd get to that's the law of large numbers. You're right, eh? You're too darn smart for us, Stu. But approachably smart, and that's what we like a Stuya base.
Well, it's often the summertime special. It's Vichyssoise didn't really seem to match up with my name, so
Well, you what did meet expectations was that tie. So let's hope that that this isn't the last time our loyal viewers get to see you in the tie. Although we will also be watching for the your color choices, because we want to see you solidly in the fall after Labor Day. So we'll talk to you next week.
okay. Enjoy the rest of the summer, Dave.
This recording has been provided by RBC Global Asset Management, Inc. for informational purposes only and is not intended to be investment or financial advice. You should consult your own legal, accounting, tax, investment, or financial planning advisors before engaging in any transactions.